Right now, as you watch this, oil tankers are turning around in the middle of the ocean. Massive supertankers loaded with crude, container ships carrying electronics and industrial materials, LNG carriers bound for China and Europe. All of them approaching the Strait of Hormuz received the same radio transmission from Iran's Revolutionary Guard Corps. The message was blunt and unambiguous. No vessel is allowed to pass. That transmission went out yesterday. The EU's naval mission in the region, EUNAVFOR Aspides, confirmed it. The United Kingdom Maritime Trade Operations confirmed it. Multiple shipping companies confirmed it independently. 20% of the world's oil supply and 25% of the world's liquefied natural gas moves through that narrow corridor of water every single day. 21 million barrels of crude oil every day through a passage that is 33 kilometers wide at its narrowest point. And as of this moment, that passage is functionally closed. The United States and Israel launched a massive joint military operation against Iran on February 28th. They called it Operation Epic Fury. Israel called their component Operation Roaring Lion. Explosions ripped through Tehran beginning at 9:27 in the morning local time. The United States targeted Iran's ballistic missile program and nuclear facilities. Israel went after the political and military leadership directly. Iran's Supreme Leader, Ayatollah Ali Khamenei, was killed in an Israeli airstrike that hit his compound in Tehran. Donald Trump announced the death on Truth Social. Iranian state media confirmed it hours later. Iran declared 40 days of mourning, and its parliamentary speaker went on state television and made a promise that will define the next chapter of global geopolitics. He said Iran would strike with such painful blows that America and Israel would beg for mercy. And then Iran did what every military analyst feared most. It struck back everywhere at once, not just at Israel, everywhere. Missiles hit Bahrain, targeting the headquarters of the United States Navy's Fifth Fleet. Explosions shook Dubai. Smoke rose over Business Bay and the Jebel Ali commercial port, one of the largest shipping terminals in the Middle East. Qatar intercepted missiles over Doha. 16 civilians were injured. Kuwait's international airport was hit by a drone, damaging Terminal 1. Sirens blared across central and southern Israel. CNN teams on the ground in Dubai and Doha reported hearing multiple blasts throughout the morning. The entire Gulf, with the sole exception of Oman, activated air defense systems simultaneously. Erbil Air Base in Iraq, which houses American troops, was attacked by an Iranian-backed militia using drones. This is not a localized conflict. This is a regional war unfolding in real time across the most oil-rich geography on Earth, with American military personnel directly in the line of fire. Trump's response was immediate. He announced that heavy and pinpoint bombing of Iran would continue uninterrupted throughout the week, or as long as necessary. He called for regime change. Iran's exiled Crown Prince Reza Pahlavi praised the killing of Khamenei and called on the Iranian military to help transition the country. The world is watching a live regime collapse attempt backed by American and Israeli firepower. And the financial consequences are about to hit every market on the planet. Gold closed Friday at $5,278 an ounce after surging $100 in a single session. Silver jumped nearly 8% to $94.30 on COMEX futures. Brent crude settled at $72.48, but analysts now project a $5 to $20 per barrel spike when futures trading opens tomorrow evening. Some are modeling scenarios where crude breaks above $100 if Hormuz remains disrupted. The Indian stock market already collapsed on Friday. The Sensex dropped 961 points. The Nifty fell 318. Bitcoin dropped $4,000 in a single session as risk assets were liquidated across the board. And markets have not even reopened yet. Monday is going to be the first chance the global financial system has to actually price in what happened this weekend. But here is what nobody in mainstream financial coverage is connecting. This war did not land on a stable silver market. It landed on a market that was already cracking under the weight of the most aggressive physical delivery demand in the history of commodity exchanges. 60 days ago, COMEX had 86 million ounces of registered silver sitting in its vaults. In those 60 days, buyers demanded delivery of 127 million ounces. That is 148% of everything in the vault. The metal is not just changing hands on paper, it is physically leaving the building, not rolling into eligible classification, not transferring between owners within the same warehouse, leaving, gone. And now, on top of that structural crisis, on top of that unprecedented physical drain, the world just shut down the single most important shipping lane on the planet and ignited a war across the region that produces a fifth of global energy. This is not a story about war. This is not a story about silver. This is the story of what happens when two crises collide at the worst possible moment, and why Monday morning is going to be a day the financial world remembers for years. To understand why the next 72 hours matter more than any trading week in recent memory, you need to see the two forces that are about to collide. The first force is the physical silver market, which entered this weekend already in emergency territory. The second force is a Middle Eastern war that just weaponized the global energy supply chain. Neither of these forces needed the other to be dangerous. Together, they create something the modern financial system has never had to process simultaneously. Start with the silver. In April of 2020, COMEX warehouses held 240 million ounces of registered silver. That is the metal sitting in approved vaults, certified and ready for delivery against futures contracts. It is the physical foundation upon which the entire paper silver market rests. As of late February 2026, that number is 86.13 million ounces, a 64% decline in less than 6 years. The decline has not been gradual. It has been accelerating. And the acceleration in the first 2 months of this year has been unlike anything in the history of the exchange. In January alone, COMEX delivered 49.4 million ounces. To put that in context, January of 2025 saw just 6.8 million ounces delivered. The year-over-year increase is 7.27 times. That is not a percentage increase. That is a multiplication. February followed with 5,036 contracts, representing 25.18 million ounces. That is the highest February delivery volume in modern COMEX history. On the very first notice day of February, January 29th, 1,881 contracts were delivered in a single session. 37% of the entire month's delivery volume concentrated into one day. That pattern tells you something important. It tells you the buyers are not waiting. They are not patient. They are taking metal the moment the delivery window opens because they need it or because they do not trust it will be there later. And now March has arrived with 10,526 contracts standing for delivery. That translates to 52.63 million ounces of demand against a vault that holds 86 million. In a single month, buyers are requesting 61% of the entire registered inventory. Add the numbers together. January, February, and March combined represent approximately 127 million ounces of delivery demand against 86 million ounces of available supply. In 60 days, buyers have demanded 86.4% of the entire registered vault. That is the highest 2-month delivery rate in exchange history. It is not a percentage you find in any normal commodity cycle. It is a percentage that suggests something structural has broken in the relationship between paper contracts and physical metal. The metal leaving COMEX is not rolling into eligible status. It is not sitting in a different classification within the same warehouse. It is departing the system entirely. Eligible inventory has stayed relatively flat while registered inventory collapses. That means the silver being delivered is physically leaving the vaults. Someone is taking those bars, 1,000-ounce bars of 99.9% purity, and putting them somewhere COMEX cannot touch them. Private vaults, industrial facilities, sovereign storage, wherever it is going, it is not coming back. Meanwhile, in Shanghai, vault inventory has fallen to its lowest level since 2016. The Shanghai premium over COMEX sits at roughly 20%, meaning silver in China trades at approximately $102 an ounce when COMEX shows 94. That is not a rounding error. That is the market telling you that physical silver in the East is worth fundamentally more than paper silver in the West. London lease rates spiked to 39% intraday earlier this year. Normal lease rates sit between 1% and 3%. 39% means someone was willing to pay 39% annualized interest just to borrow silver for a short period. That is the behavior of a market in distress. The entire global physical infrastructure for silver is signaling the same message. There's not enough metal to satisfy the demand that already exists before any war premium is applied. If the system connecting silver supply chains, the institutional architecture that makes it possible to move physical metal from mines to refiners to exchanges to industrial users, was already under maximum strain, what happens when you drop a regional war on top of it? What happens when the shipping lanes that connect Eastern supply to Western demand become contested military territory? If this kind of structural analysis is valuable to you, take a second and hit like and subscribe. Because what I am about to walk you through is the collision point that mainstream finance is not modeling. And it changes the math on everything. Now look at the second force. The Strait of Hormuz is not just an oil corridor. It is a 33-kilometer wide bottleneck through which roughly 21 million barrels of crude oil pass every single day. That represents a fifth of the world's seaborne oil trade. Another 20% of global LNG exports transit the same water. Qatar, the world's largest LNG exporter, depends entirely on this passage. Saudi Arabia, Iraq, the UAE, Kuwait, and Iran itself all route the overwhelming majority of their energy exports through Hormuz. There is no alternative. The Saudis have a pipeline that can bypass the Strait to the Red Sea, but its capacity covers only a fraction of total Gulf output. The UAE has a pipeline to the Gulf of Oman. Everything else must go through Hormuz. On Saturday, after Iran was hit by American and Israeli forces, semi-official Iranian media declared the strait practically closed. The IRGC broadcast VHF radio warnings to all ships declaring that no vessel is allowed to pass. The EU's naval mission in the region confirmed receiving these transmissions. The UK maritime trade operations confirmed them independently. Multiple oil companies and trading firms paused all shipments through the waterway. Tankers that had been approaching Hormuz turned around. A large number had already paused near the entrance to wait. The United States Naval Forces Central Command issued a maritime warning zone across the entire Persian Gulf, the Gulf of Oman, the North Arabian Sea, and the strait itself, telling commercial vessels it could not guarantee their safety and instructing all ships to maintain at least 30 nautical miles from naval vessels. This is no longer theoretical risk assessment. This is operational reality. Insurance brokers have submitted cancellation notices for policies covering ships transiting Hormuz. War risk insurance rates are expected to rise as much as 50% in the coming days. Without insurance, tankers do not sail. Without tankers, oil and gas do not move. And without oil and gas moving through the world's most critical choke point, the global economy enters a kind of systemic shock that no central bank can fix with interest rate adjustments or liquidity injections. You cannot print oil, you cannot print silver, and you cannot force a tanker through a strait where the Iranian Navy is broadcasting live warnings and missiles are hitting ports across the Gulf. Here is where the two crises stop being separate stories and become one. The mechanism is straightforward, and it operates through three channels simultaneously. The first channel is inflation expectations. When oil prices spike, the cost of transporting, manufacturing, and producing everything on Earth rises with them. Oil is not just fuel, it is the metabolic energy of the global economy. Every product you touch, every piece of food you eat, every electronic device in your pocket required oil to exist. When crude jumps $5, $10, $15 a barrel in a single session, inflation expectations do not adjust gradually. They snap upward. And when inflation expectations snap upward, institutional capital moves toward hard assets with the speed and force of a reflex. The two hardest assets on the planet are gold and silver. Gold has already demonstrated this reflex. It jumped $100 in a single session on Friday, closing above 5,278. Multiple analyst desks are now discussing 5,300 as the immediate resistance test for Monday, with $6,000 as the medium-term target if the conflict escalates further. The second channel is accessibility. Gold is expensive. An ounce of gold costs more than $5,000. An ounce of silver costs $94. For the retail investor looking at their savings account and wondering how to protect purchasing power, for the mid-sized institution that needs to deploy capital into hard assets without concentration risk, for the emerging market central bank diversifying reserves without spending $5,300 per unit, silver is the accessible entry point into the safe haven trade. This is not theory. It is observable. Every time gold reaches a new psychological threshold, silver demand accelerates disproportionately, because the pool of buyers who can afford silver is orders of magnitude larger than the pool who can afford gold. At $5,300 per ounce, gold is pricing out a significant portion of global safe haven demand. That demand does not disappear. It flows into silver. The third channel is silver's dual identity, and this is the one that makes this particular crisis structurally different from anything the precious metals market has faced before. Silver is simultaneously a precious metal and an industrial metal. More than half of global silver demand comes from industrial applications: solar panel manufacturing, electric vehicle production, semiconductor fabrication, AI data center construction, medical equipment, telecommunications, infrastructure. Every one of those industries depends on physical silver that has to be mined, refined, shipped across oceans, and delivered to factory floors on a precise schedule. Now consider what happens to industrial silver supply chains when the Strait of Hormuz is contested and the entire Gulf is an active war zone. Even if the physical closure lasts only days, the insurance disruption alone will echo for weeks or months. Brokers have already submitted cancellation notices for war risk policies covering Gulf transit. The Financial Times reported that premiums are expected to rise as much as 50% in the coming days. Without insurance, tankers do not sail. Without tankers, raw materials do not move. Freight premiums will surge across every shipping corridor connected to the Gulf. Delivery timelines will stretch. Manufacturers who operate on just-in-time inventory models, which describes the majority of modern industrial production, will scramble to secure whatever physical silver they can find from whatever source is available. And they will be competing for that silver against investment buyers who are fleeing into precious metals as a safe haven against the same geopolitical chaos. This is the dynamic that creates a genuine supply crisis, not a theoretical one, debated in precious metals forums and silver stacking communities. A real one measured in empty shelves, broken delivery commitments, extended lead times, and prices that gap higher faster than any model predicted, because both sources of demand, industrial and investment, are accelerating simultaneously for the same underlying reason. The war does not create separate buying pressure. It creates compounding buying pressure. The industrial buyer needs the metal to keep factories running. The investment buyer needs the metal to hedge against inflation and instability. Both need the same physical ounces from a market that was already running short before the first missile was launched. Look at the historical parallels, and the pattern becomes impossible to ignore. In 1973, the Yom Kippur War and the subsequent oil embargo sent gold up 369% and silver up 200% over the following years. The embargo reshaped global finance and gave birth to the petrodollar system. In 1990, Iraq's invasion of Kuwait triggered an immediate gold spike as oil supply fears gripped markets. In 2003, the Iraq invasion drove another surge in precious metals. In 2022, Russia's invasion of Ukraine pushed gold up 18% in a matter of weeks. Every major Middle Eastern conflict in the last 50 years has driven precious metals higher, every single one without exception. But there's a critical difference between those historical episodes and what is unfolding right now, and it is the difference that makes this moment unprecedented. In every previous conflict, the silver market entered the crisis from a position of relative inventory strength. There was slack in the system. Warehouses had metal, mines were producing at capacity, supply chains were intact, and shipping lanes were open. The system could absorb a demand shock because there was buffer built into the infrastructure. In March of 2026, silver enters this war with COMEX vaults at 64% below their 2020 peak. Shanghai inventories sit at their lowest since 2016. London lease rates have touched 39% intraday, 20 to 30 times above normal levels. The silver market is in its fifth consecutive year of global structural deficit, meaning annual demand exceeds annual supply, and the gap is being filled by drawing down inventories that are now nearly exhausted. Managed money speculative positions have collapsed 77.7% year over year, from 54,415 contracts to 12,121. The speculators have already been flushed out. They are gone. What remains is real demand from real buyers who want real metal. Industrial consumers, central banks, sovereign wealth funds, long-term institutional holders, the kind of buyers who do not sell into a panic, the kind who buy more. Analysts surveyed before this war even started had already projected silver reaching $100 per ounce in 2026. Gold Silver's lead analyst called for $175. BNP Paribas said 100 was certainly possible by year-end. CoinCodex's algorithm predicted $99.35 by March 6th, which is 5 days from now. That was the forecast before Khamenei was killed, before Hormuz was closed, before the entire Gulf became a battlefield, before oil tankers started turning around. The question is no longer whether silver reaches $100. The question is how far past 100 it goes when Monday's trading session opens, and every fund manager on the planet simultaneously realizes that the two biggest risk factors in the global commodity market just merged into one. So here is what all of this adds up to, and it is the part that most analysis is missing entirely. The mainstream financial narrative right now is covering this as two separate events playing on two separate screens. On one screen, you have war coverage, explosions in Tehran, diplomatic statements, missile trajectories over the Gulf, regime change rhetoric. On another screen, you have commodity prices, gold tickers, oil charts, analyst upgrades, silver futures. What almost nobody is doing is mapping the physical supply chain from one screen to the other and asking the obvious question that connects them. If the world's most important shipping corridor is contested, and the world's most important silver exchange is already running at critically low inventory, and the world's largest silver-consuming industries depend on global shipping to receive their raw materials, and the world's largest pool of investment capital is about to panic buy hard assets as a refuge from uncertainty, then what exactly is the plan? Who has modeled this scenario? What exchange has a contingency for when two systemic crises converge on the same physical commodity at the same time? COMEX operates on a system of registered and eligible silver. Registered is metal that sits in the vault, certified and immediately available for delivery against futures contracts. Eligible is metal stored in the same vault that meets purity and weight standards, but is not currently offered for delivery by its owner. Think of registered as inventory on the shelf with a price tag. Eligible is inventory in the back room with the owner's name on it. The hope, the implicit assumption built into every risk model at every major exchange and every clearinghouse is that when registered inventory gets dangerously low, eligible holders will convert their metal to registered and make it available at the right price. The system has a relief valve, in theory. But that conversion requires a willing seller. And in a market where silver is approaching $100 an ounce with war raging across the Middle East and the most important shipping lane on Earth disrupted, and insurance companies pulling coverage, what rational eligible holder converts their silver into a deliverable category today? The incentive is overwhelmingly to hold, to wait, to let the crisis deepen and the price rise further before making metal available, if they choose to make it available at all. Many eligible holders are industrial companies and institutional investors who want that silver for their own purposes. They are not sitting on it as a favor to the exchange. They are sitting on it because they need it or because they expect it to be worth significantly more in the near future. That is not a conspiracy theory. That is basic economics. You do not sell into a rising panic unless the price compensates you for the risk of not having the metal when you might need it most. And no price has yet been sufficient to trigger meaningful conversion of eligible to registered. This creates a feedback loop that tightens with every passing day. Low registered inventory drives urgency among buyers who need physical metal. Urgency drives the price higher as buyers bid more aggressively. Higher price discourages eligible holders from converting because the expected future price exceeds the current price. Less conversion keeps registered inventory low or pushes it even lower, and the cycle tightens. Each rotation of this loop concentrates physical silver in fewer hands and widens the gap between what the paper market says silver is worth and what you actually have to pay to take delivery of a physical bar. Now layer the war on top of this existing loop. Industrial users who might have waited until May or July to secure their silver supply for second half manufacturing are now pulling forward their demand into March because they cannot guarantee that supply chains will function normally next month. If the Strait of Hormuz remains disrupted for even a week, delivery timelines for refined metals from the Gulf region and connected Asian supply chains will extend by weeks or months. Manufacturers cannot afford to wait. They are accelerating purchases now. That front-loading of demand hits an exchange that is already processing the largest delivery month in its recent history, with the lowest registered inventory in its modern history, during an active military conflict in the world's most strategically important maritime corridor. The CME Group, which operates COMEX, has already raised margin requirements this year in response to silver's volatility. Margin hikes are the exchange's blunt instrument for cooling speculative excess. You raise the cost of holding a position, and the marginal speculator exits. It works against speculators. But when the demand is not speculative, when the demand is coming from industrial consumers who physically need the metal, and from institutional investors making strategic allocation decisions based on geopolitical risk, margin increases do not reduce demand. They just make it more expensive to participate, pushing smaller players out while the large industrial consumers, sovereign wealth funds, and central banks continue to accumulate. The result is a market that concentrates physical supply in fewer and fewer hands, while the price signal screams at the rest of the world that something fundamental is broken in their relationship between paper and physical. There's a number that captures this perfectly. In February of 2025, managed money held 54,415 net long contracts in silver futures. By February of 2026, that number had fallen to 12,121. A collapse of 77.7% in speculative positioning. The hot money is gone. The momentum traders have exited. The leveraged speculators were wiped out during this February correction when silver crashed from $121 to $70. What is left is structural demand, the kind of demand that does not roll over when margins go up or when a talking head on financial television says silver is overbought. The kind of demand that takes the metal out of the vault and does not bring it back. The kind of demand that represents a permanent transfer of physical resources from the paper pricing system to the real economy. Here's the question that defines this moment, and I want you to think about it carefully. If COMEX registered inventory sits at 86 million ounces, and March delivery demand is 52 million, and eligible holders have no incentive to convert, and industrial users are front-loading purchases because of war-related supply chain fears, and investment demand is surging because gold at $5,300 pushes capital into the more affordable precious metal. And the Strait of Hormuz is disrupting global shipping, and insurance companies are canceling coverage for Gulf transit. And Houthi forces in Yemen have announced they will resume attacks on Red Sea shipping in solidarity with Iran, effectively threatening the second major maritime corridor. Then where does the physical silver come from? Not the paper silver, not the futures contract, not the warehouse receipt that can change hands 20 times without a single bar moving. The actual metal, the bars, the refined product that a solar panel manufacturer in Germany or an electronics company in South Korea or an EV battery producer in China needs to keep its production line running. That is the question I want you to sit with. Because nobody in mainstream coverage is asking it. Nobody on financial television is connecting the Hormuz closure to the COMEX vault data, to the insurance cancellations, to the industrial demand pipeline. They are covering each piece in isolation because isolation is comfortable and convergence is terrifying. Drop your analysis in the comments. I read every single one, and some of the most important perspectives on this channel come from the community watching this right now. The gap between paper promises and physical reality has never been wider. And what is about to happen is not a price movement. It is a reckoning. Let us pull back and see the full picture. Because when you stand at a high enough altitude, when you stop looking at individual data points and start seeing the architecture, the pattern becomes unmistakable. For decades, the silver market operated on an implicit agreement between the exchanges, the banks, the refiners, and the industrial users who depend on silver for their products. Futures exchanges could issue paper contracts representing far more silver than physically existed in their vaults because almost nobody actually demanded delivery. The system worked on trust. Trust that the metal would be there if you ever needed it. Trust that the price on the screen reflected what a physical ounce was actually worth. Trust that the warehouse receipts meant something. Trust that the clearing system could handle stress. That trust has been eroding for 6 years. Since April of 2020, over 153 million ounces of registered silver have disappeared from COMEX vaults. That is not a fluctuation. That is a structural migration of physical metal away from the paper pricing system and into private hands, industrial pipelines, and sovereign vaults where it cannot be lent, leveraged, or rehypothecated. China reclassified silver as a strategic material and restricted exports. Emerging market central banks began accumulating. Industrial consumers started demanding physical delivery rather than rolling contracts forward. Each of these shifts, individually, was manageable. Together, they represent a fundamental break from the old model. And now, in March of 2026, the final accelerant has arrived. Not from the silver market itself, but from the geopolitical stage. A war that threatens to close the most important shipping lane on Earth, destabilize the most important energy-producing region, collapse the insurance framework that global maritime trade depends upon, and trigger the largest flight to safe haven assets since the 1970s. This is not a prediction of what might happen. It is a description of what is already happening right now as you listen to these words. Gold has already surged past 5,300. Silver has already jumped 8% in a single session. Oil tankers have already turned around. Insurance companies have already issued cancellation notices. The Iranian Supreme Leader is already dead. The missiles have already hit Dubai, Qatar, Bahrain, and Kuwait. The only thing that has not happened yet is Monday. And Monday is when every market on the planet reopens and prices and what the weekend revealed. Oil futures will gap higher. Stock indices across Asia, Europe, and the Americas will open under pressure. Treasury yields will swing as capital searches for safety. And precious metals, gold and silver, will absorb the full force of global fear, seeking a tangible, physical refuge from a world that just became dramatically less stable. For silver specifically, the math is unforgiving. At $94 an ounce entering the weekend, the metal was already within striking distance of its January all-time high of $121.62. The crash to $70 in mid-February was driven by margin hikes and the brief appointment panic around the Fed. That selling has been fully absorbed. The recovery from 70 to 94 took less than 2 weeks. The market has demonstrated that the bid underneath silver at these levels is deep, institutional, and structurally motivated. A war-driven gap above $100 is not just possible on Monday. Given the convergence of forces, it would be surprising if it did not happen. But the real story is not one day's price action. The real story is what this moment reveals about the architecture of global commodity markets. For 40 years, the West has priced silver in New York and London through paper derivatives that float above the physical market like a separate currency. That system worked as long as the physical market was well supplied and no one asked too many questions. The physical market is no longer well supplied. The questions are getting louder and the answers are getting harder to deliver, literally. Shanghai already prices silver 20% above COMEX. That premium is not an anomaly. It is an arbitrage signal telling the world that the Eastern market, where physical delivery is the norm, values silver differently than the Western market, where paper settlement is standard. As more metal flows east and less remains in Western vaults, the Western pricing mechanism loses its anchor to reality. The price you see on COMEX becomes less a reflection of what silver is worth and more a reflection of what a financial contract derived from silver is worth. Those are two very different things, and the gap between them is the gap through which the entire repricing of silver will eventually flow. Here is what is in your control. Understanding the difference between paper exposure and physical ownership. Understanding that a war in the Gulf is not just a geopolitical headline you scroll past on your phone, but a direct threat to the supply chains, that move physical commodities from where they are produced to where they are consumed. Understanding that 86 million ounces in a vault sounds like a lot until you realize that 127 million ounces were demanded in the last 60 days, and that the number only goes up from here. Understanding that every war in the last half century has driven precious metals higher, and that this war started from the weakest supply position in modern silver history. When this video started, I told you about oil tankers turning around in the middle of the ocean. Massive ships loaded with crude reversing course because a radio transmission from the Iranian Revolutionary Guard told them that passage through Hormuz was forbidden. That image is not just about oil. It is a metaphor for an entire financial system that built its models on the assumption that global trade flows would remain uninterrupted, that supply chains would always function, that the metal in the vault would always be there when someone needed it, that the price on the paper contract would always converge with the price of the physical bar. Every one of those assumptions is being tested right now, simultaneously, under conditions of maximum stress, and the test results arrive Monday morning when futures markets open and the world discovers what this weekend actually means in dollars, in ounces, and in barrels. The strait is closed, the vaults are draining, the war is expanding, and the price of silver, the real price, the one measured not in futures contracts, but in physical bars, changing hands between people who understand what is coming. The price is about to detach from everything the old system told you to believe. The empire is not collapsing, it is being repriced, and the repricing starts tomorrow.